Hi class. This video is a simple overview of Chapter 7. Now first, basically time value of money. We've got some definitions here. So it means basically that the value today is different from the value of a dollar that you might receive in the future. It's very important in accounting to be able to compute time value of money. Oftentimes we need to use time value of money to value assets and liabilities. So for example, in long-term liabilities, we have leases, pensions, and bonds payable. All of those are reported on the balance sheet using present value. So the present value is the amount that shows on the balance sheet, not the amount that we're eventually going to pay out maybe 10, 25 years from now. We've got a few terms that we need to kind of have some notes on. You'll see these questions in quiz questions and possibly in your homework. Basically, there's two kinds of interest. We have simple and compound. And in simple interest, basically we compute the interest simply on the principal. You've used these formulas before. Notice the formula at the bottom, principal times interest rate times time. You used this formula back when you were in chapter 4, let's say, and you were accruing interest that might have accrued on a note, and you had to do maybe the principal of the note times the interest rate and then some fraction of the year, maybe 6 out of 12 months. So you've done that before. Now we're going to get into the next kind, which is compound interest. So if the interest is compounded, basically you're earning interest on your interest. And so, for example, if interest is compounded monthly, 1 month comes by, and at the end of that month, the interest is computed. That interest is then added to the amount of the principal. So when you get into the second month, the beginning balance is now the principal plus the interest earned on that first month. So you're going to be compounding monthly. That means every month, at the end of the month, you see what interest has been earned, you add that to, and then you keep on earning interest on top of that. What happens with this is that if you are the one investing, the more frequently that the interest is compounded, the better off you are. On the flip side of that, if you are somebody that owes, for example, like with credit cards, if your interest is compounded and then you don't pay that credit card, you know what's going to happen if you don't pay that balance off. You're going to be then given some interest that you owe, and now you owe the original amount from all your purchases plus amount on interest. And so that can keep spiraling into a pretty hefty amount if we let those credit cards go out of control. So that's simple versus compound interest. What happens with this is that it gets a little tricky. So interest rates are always stated as an annual amount. And when the interest is compounded more than once a year, basically we have to figure out what that interest rate is in order to compute the amount of interest. So like I said, when you had a 12 months compounded monthly, if you had a 12% interest for the year, then it would be 1% for each of the 12. And what happens with that is since you're compounding, you're actually earning more than the annual amount. So if you compound 12%, if you compound it monthly, you'll end up getting a return that's higher than 12%. Okay, so a couple more terms. The present value is the value of the cash today. So you can look at cash flows in the future and bring them back as to time equal to 0, which is today, and we'll find out what the present value of that is. The future value is we know something maybe about the present, and we want to determine how much money we will have in the future. So we want the future value. And we use both of these in accounting. The terms that go along with this is compounding and discounting. So discounting is when you have that future value amount and you want to find out what the present value of it is today. And this might be important, let's say in cost accounting, you're looking at doing a couple different maybe product choices, and you're trying to decide which of these alternatives would be the best, which has the highest net present value. So perhaps you've done that in a finance or a cost accounting class. Compounding is go in the opposite direction, where you know something about present value and we're compounding to find the future value. And then the last bit of our terms here have to do with what's called an annuity. So basically an annuity is a series of periodic payments, and the time between each payment is equal and the dollar amount is equal. So maybe $1,000 every 6 months. That's an annuity. Annuities can then be called either an ordinary annuity or annuity due. So when payments take place at the beginning of the period, that one's called an annuity due. When the payments occur at the end of the period, then that is an ordinary annuity. All right, we're going to see some examples of this as we get into the next video, which is just going to be an overview of how to solve some of these problems. One last thing I wanted to add is that there are four different ways for us to solve time value of money problems. We are going to just focus on Excel, the spreadsheet application solution. Your textbook covers all four methods and is very detailed. So perhaps you have a financial calculator and you like to use it. Well, you can follow along with your book with that one. The formula solution, you probably have maybe had that from a prior math class. And also there's tables. So we'll talk about mostly it'll be the Excel-based solutions to time value of money problems.